Hey guys, how's it going? So, the onslaught has continued. We just saw the worst day in the Dow since 1987. Wow, I never thought that this would be happening this quick, even though I had my concern about how fast the market was going up. We saw the Dow today down over 2,300 points. Oh my gosh, 10% roughly. The Dow was down today. The S&P was down 260 points. Again, about 9.5%. Crude, because we're going to be getting into this a little bit today, crude oil was about $31 per barrel. And if you're a Canadian, I mean, the TSX just got destroyed today, down about 12.34%, down over 761 points. Wow, so what a day again here today. So in today's video, what we're going to be talking about is we're going to be briefly going over what has led up to this, what's going on right now, what I'm doing, what I think you guys should be doing, just in my own personal opinion. And then we're going to be looking at some stocks. They're getting pretty attractive that I'm thinking I might buy pretty soon here, maybe within the next couple days, depending on what's happening. And also, importantly, stocks that I'm not going to be touching. For various reasons, so we will get into that. So if you don't know what's going on in terms of this virus, we can't say the word again because YouTube is all anal about this for some reason. That word's probably going to get triggered. I'll put a link right here to the video where I actually explain the numbers and why I think this is completely overblown, although now it appears that the market is taking it very seriously, so of course I'm taking it seriously as well. Of course, this virus started in in China, and it is in Japan now, began to spread, and the markets didn't really respond until the spread became more prevalent. Italy got hit hard, it was locked down, and then we saw a double whammy the other day. The Saudis and Russia decided to go into a price war for the low-cost producer, because as you know, they are very low-cost producers in terms of crude oil. So we saw a day where oil was down about 30% at one time. Insane. I haven't seen that for a while. It was below $30 a barrel for a while. And of course, this has knock-on effects in the economy. If you lose a lot of jobs, there's a huge amount of jobs. Say if we talk about just in the States, I'm not going to talk about Canada, but in terms of the States, if you see, by some estimates, there's a million, maybe a couple millions, perhaps, I'm not 100% sure, they lose their jobs, and then they stop spending, and then that coupled with the virus, of course, could be really bad news, and that's why the market is just freaking out right now. Then we've seen an acceleration of the response from everything from the World Health Organization saying that this is a pandemic. That was yesterday, and now we see that the NHL season has been postponed. NBA, all the areas and all the advice that's been given in terms of not to allow this to spread. And of course, you got to think about all the knock-on effects of that as well. People that are flying out to there, I mean, the flights, the airline industry is just getting decimated. But you got to think about all the vendors for all these different things, and it just spreads to one area to the other, right? So I definitely take that very seriously, even though I think this is very overblown. Of course, just prior to me making this video, we saw that the New York, of course, declared a state of emergency, so areas like Central Park might just be shut down. I mean, this is kind of crazy. I didn't think that I would be seeing something like this, in my lifetime to this extent. But like I said, this is a vicious cycle. You got to think about all the vendors. And so that's, I think, what's really affecting the stock market right now, and the huge amount of concerns about the economy. I won't go over too much what I talked about in my other video, but I do think it's overblown in terms of this is a short-term event. I mean, the virus doesn't live forever. So even if this is catastrophically bad, it will end, right? Some of the other recessions that we've seen, 2008, that was financial related. 2001, to a large extent, the tech bubble is just ridiculous evaluations. We haven't seen any of that. So this is an outside factor that will end. And I think that's the way you got to think about it when you're freaking out. It will end at some point. there might be a lot of carnage in the, in the meantime, but what does that mean if it's going to end if you can get things cheap? So that's something I want you to think about going forward. So what should you do? I mean, this part of this video is, not only we're going to be looking at some stocks that I think are good buys right now, but what should you be doing in your own life? Of course, this is all up to you. You should seek a financial advisor and stuff like that. But what you should definitely be doing is looking for as much cash on the side as possible, of course. I mentioned this in one of my other videos, so any way that you can acquire cash, I'd be holding as much cash as you could. That includes getting side hustles or something like that. Now is the time to clamp down, and not just because you could potentially be out of work depending on where you are in your life or in the world, but just because of all the amazing buying opportunities that could be transpiring here soon. So that is something that's very important to always be prepared for. And when you see the market starting to respond to the way that it is right now, wow, you want to have some cash. And again, like I said in some of my older videos, don't invest what you can't afford to lose or wait out. And this is a very, very good example of that. Who knows how long this could go for? And if you're too overly invested in the market right now, in my opinion, now is not the time whatsoever. We're just basically taking out the early 2019, 2018 low there, and basically just wiped out the entire year or a little bit more. So not a good time whatsoever. So that's what I think you should do. The biggest piece of advice I want to give you, though, is to stay calm. If you cannot handle this, in my opinion, you shouldn't be in the market, right? For me, I almost see it as a positive in some ways. I mean, it's awful what's happening around the world, but in terms of the stock market, I see it as a positive because, personally, I have some, inverse market ETFs that are going to be billing me more cash because they're skyrocketing. One of them was up over 25% today. But also, I do have cash on the side, right? So I know that the market will eventually recover, and we know that this is a short-term event. No matter how bad it gets. So, like I said, if you can't handle this, you probably shouldn't be in it for the long term or the short term. There's an old saying that fortune favors the bold, the bold and the brave. So you got to have that real tough skin right now. So now what we're going to look at, probably what you came to this video for. I've been scouring the markets. I'm not ready to buy just yet because of the ensuing panic, which is just people are losing their minds, and I think we're not quite at the depths of that yet. So let's take a look at the first stock that I'm interested in right now. This is a stock that I should have made a video on quite some time ago. I've been long this stock for a long time, but I wanted to do an in-depth presentation for you guys on it. But the name of the company is Fortis. Now, I'm looking at the Canadian company here, or the one that's on the Canadian exchange, the Toronto Stock Exchange, but it's also US listed. So if you're a US citizen, don't worry, you don't have to be buying on the Canadian exchange or anything like that. So Fortis operates as an electric and gas utility company in Canada, the United States, and the Caribbean countries. It generates, transmits, and distributes electricity. The company also sells wholesale electricity to other entities in the United States, owns gas-fired and hydroelectric facilities. And also they're involved in solar, and they provide management and maintenance to many of their facilities. So that's just a quick rundown of what they do. Of course, now is the time that I want to be in a utility, especially one like this that is highly dependent on regulation. We'll get into that in a bit here. The PE is very reasonable now. It's about 12.51. The yield is about 4%. Now keep in mind, a lot of these yields are, I think Yahoo Finance is not keeping up. I'm making sure that they're updated myself. But as of today, it was 4%. The payout ratio, now the payout ratio is how much of their net income they pay out to dividends. Now this is something that I'm following very closely lately, because if we see a downturn for a while, we need to know, if this dividend is stable. There's a lot of different ways to look at that, but a payout ratio is a great way to do it. So theirs is relatively low at 48.35%. On all these companies that I'm going to be showing you guys, we could go through a lot more information. We can go through their income statement, stuff like that. But considering we're maybe looking at these companies for long-term holds. If there's potentially some really bad news on the horizon, we're looking at companies that have strong balance sheets. I thought we'd take a quick look at their balance sheets. So Fortis, they have about $370 million in cash, about $22.22 billion in debt. So they have a lot of debt, which is not necessarily great, but I think in their case, it's not the end of the world. I'll get into that for a bit. Then another ratio we're going to be looking at is the current ratio. Now theirs is 0.62. Now if you're not aware what the current ratio is, it's essentially a liquidity ratio. So it's measuring the company's ability to pay its short-term obligations that are usually due within a year. So it's kind of telling, analysts if a company if the company is actually maximizing its current assets on its balance sheet. So the ratio, of course, is current asset divided by current liabilities. And of course, current assets are assets that are cash or will be turned into cash in a year or less. And then same thing with liabilities. So the best way to think about it is just the ability of the company to be kind of solvent or have a going concern in the short term, and that's something that we're going to be focused on right now, because I think this coronavirus thing, oops, I said it there, is not going to last much longer than a year, but who knows. Of course, the stock has been on fire this year. I've done very well on it, but look at that drop. Like a lot of things right now, it's pulling back, so it's getting to a point that's quite attractive for me. What really attracts me to this company, though, is their extreme focus on dividends and increasing dividends and their growth rate. 99% of their earnings is from regulated utilities. So like in Canada here, that's not going away. So if you look at how much debt they have as a concern, well, it's not like this is a company that relies on other vendors or anything like this. People are going to continue to use electricity. It's only going to get bigger in the future, and Fortis is pushing hard into the States, right? They're really going, very fast-paced into the States. They have over 46 years of consecutive dividend increases. So we're looking at almost 50 years there, and they tout that all over the place. They want to keep these dividends in place for as long as possible, and they also tout that they have 10 years of superior growth returns. So in terms of adding to my position on this one, I just might, although I already have a relatively big position, so I'd like to diversify a bit more, but we'll see going forward. If this pulls back further and the yield just gets really high, I might seriously consider getting some more of this one. The next company is one that you're probably quite aware of. That's 3M. If you're not aware of what 3M does, they develop, manufacture, and market various products worldwide. And it operates through four business segments. So safety and industrial, transportation, electronics, healthcare, and consumer. Now those last two, I think, are obviously, even considering what's going on right now, will be something very important. In terms of their safety and industrial segment, they offer personal safety products, adhesive tapes, abrasive closure and masking system, electrical markets, etc. Transportation and electronic, they provide electronics such as materials, display materials and systems, electronic material solutions, automotive, aerospace, and commercial solutions. I mean, they just do so much. Their healthcare segment offers medical solutions, oral care, separation and purification sciences, health information systems, drug delivery systems, and food safety products. And of course, their consumer segment provides home improvement, home care, consumer healthcare products, of course, stationary offices, supplies. We've all heard of 3M, 3M Post-it notes. They also provide, the segment also is involved in the retail auto care business. So they provide, have you ever heard of the 3M protectant on your car, stuff like that? Just a ton. I won't go into the rest here because it's just so diversified, and that's kind of what I like about the company. Of course, you probably know that right now they make the masks, and I think that's actually something that might drive their business a little bit. I'm surprised the stock really hasn't responded on that. Taking a look at the stock here, this company has almost had a double whammy. There's been a lot of macroeconomic forces outside their control. 2018, they got hammered. And then, this is followed by a first quarter 2019 weak earnings. report. Basically, this is about inefficient operations, caused by year-over-year adjusted operating income. And this actually happened to all 5 of their business segments. So they actually management followed, that is, by making one of the largest acquisitions in the company's histories. They were to acquire a healthcare leader. I don't know how to say that name, but I'll put it up on the screen right here, Acelity, and they paid $6.7 billion to bolster their own wound care unit. Now, I think that's good because I think healthcare is going to be great going forward, but of course, that was also taken into account in terms of the negativity of what was happening in the stock. And of course, in order to afford the acquisition, they announced that they would reduce their share repurchase program. So the previous target was $2 billion to $4 billion, and now it was to no more than $1.5 billion in 2019. And of course, the big trend has been stock buybacks. In addition to that, they gave weak guidance going forward, which in hindsight maybe was a good thing. So, some bad news that was going on there, but that was quite some time ago. Now, the PE on this company is really cheap, about 17 times earnings right now. It's yielding over 4.33%. This payout ratio is quite high, though, 73.75%. So that's something to watch. Looking at the balance sheet, good thing they have quite a bit of cash on the balance sheet, about $2.45 billion. But they do have a lot of debt, $21.3 billion, of course. And their current ratio is actually not too bad. It's about 1.41. So they're actually pretty solid in the short term. Of course, I think the reasons that I would be interested in this, other than the yield getting higher if it drops further and the PE being quite low, is that they're pushing more into healthcare. And healthcare does play into this issue that we have right now, but I do think healthcare is going to be huge going forward. And I think that it could test its highs, in sometime in the future. So this is one I'm going to be watching very closely, and if it gets hammered any harder, I might add a little bit more to it. I did buy some of this a little while ago. I'm slightly down, not too much, but I'll be looking at this one close going forward. The next one is Starbucks. Now, you probably know what Starbucks is, unless you're completely just, do nothing with your life, don't even get out. But briefly here, Starbucks Corporation, together with its subsidiaries, operates a roaster, marketer, and retailer of specialty coffees worldwide. Of course, they operate in 3 segments: the Americas, International, and Channel Development. Its stores offer coffee and tea beverages, roasted whole bean and ground coffees, single serve and ready to drink beverages, and iced tea, and various food products such as pastries, breakfast sandwiches, and lunch items. This is one I'm actually very interested in. I'm just kind of waiting on this one. You take a look at the stock, look at this, how it's just got hammered here. It's incredible to see this. I mean, pretty soon we're going to be looking at 2018 levels. And the PE is very reasonable at 20 times earnings roughly. The yield isn't that high. That's the only reason that I've kind of stayed away from it. It's about 2.64%, but the payout ratio is very nice, under 50%. So the sustainability of this company, I think, is very good. In terms of their balance sheet, they have $3.11 billion in cash, $20.63 billion in debt. So not a bad position right there. And the current ratio isn't great either. It's about 0.68. But of course, there's a lot of other factors involved with that. So just because I think this is such a solid long-term bet, I almost did McDonald's for this one because I'm also looking at McDonald's as well. But in terms of some of the metrics here, I think this one's very attractive. And if it falls back a little bit more, I'll be looking at buying some. Now, next I'm going to be looking at 2 companies that I would not touch right now. And I just wanted to preface this with the fact that one of them is pretty popular. And of course, this is just an educational channel, guys. And there might be a lot of disagreements with this one. But I just wanted to let you guys know that going forward and to really listen to what I have to say, because the one that is quite popular, I might be looking at buying into it. It's just right now, I wouldn't touch it. Taking a look at the first one here, we're looking at Boeing. Now, if you don't know what Boeing is, together with its subsidiaries, it designs, develops, manufactures, sales, services, and supports commercial jetliners, military aircraft, satellites, missile defense, human spaceflight, and launch systems and services worldwide. The company operates through 4 segments: commercial airplanes, and that's one that can be a big concern right now, defense, space and security, Global Services, and Boeing Capital, which is like their finance kind of department. Taking a look at the stock, oh my God, this thing has just been destroyed. I mean, people are kind of losing their minds on this one right now. Of course, this whole thing started with the the 737 Max crash, and now we've had this market on top of it. And so that's kind of the reason that you've seen such a crazy drop here. But going forward here, it doesn't have a PE right now because all the stuff going on right now, but its forward PE is about 9.55. Wow, that's low. Yield of about 5.3%. Again, that's if they keep their dividend, and their payout ratio is really quite big at about 180%. Again, that's a little messed up right now depending on what their earnings come in like. Looking at their balance sheet is actually pretty good. They have $10 billion in cash and total debt of $28.53 billion, and the current ratio is actually really good right now at about 1, and that's about where you'd really want to be on that ratio. Now, some of the reasons I wouldn't touch this. Okay, I was looking at this one before because of the 737 fiasco and thinking that I might get a good buy. But now we're also seeing the double whammy in terms of the airlines. Nobody wants to fly right now. And nearly 50%, yeah, that's 50, of Boeing's revenue comes from commercial aircraft. So I think that's why the stock is responding the way it is. And like I said, coupled with a virus and the 737 crashes, this could hurt this division even more. And that's 50%, right? In addition, we have a huge lack of confidence and trust with BA because of how they dealt with the whole thing, how they're allegedly withholding some information. So, trust with these companies is obviously huge as well. And also, they have huge pensions that they need to finance. And of course, not too long ago, they were actually, basically funding some of their pensions with their own stocks. So that couples with the issues here right now. So this is one that I don't know. I could see maybe in the short term them cutting their dividend, which is what's going to basically be attracting somebody. Long term, I think this thing's going to be fine. But in terms of how this shakes out, I think it could easily hit $100 a share or less. I wouldn't touch it right now. Now on to the really controversial one here. Well, it's not just one, it's all of them. It's the cruise industry in terms of the cruise ships more specifically. I could have done a couple different ones here, but the one that is really quite popular right now is Carnival. Carnival Cruise Lines. If you don't know what they are, they of course operate a leisure and travel company, and the company's ships visit approximately 700 ports under the Carnival Cruise Line, Princess Cruises, Holland America Line, Seabourn, P&O Cruises, and that's in Australia, Costa Cruises, Adia Cruises, P&O Cruises UK, and Cunard brand names. I've never heard of that name. It also provides vacations to various cruise destinations, as well as owns and operates hotels, lodges, glass domed rail cars, and motor carriages. Looking at the stock on this one blows my mind. I almost feel like I'm in dream world when I look at this one. Look at this. This is like hitting 2008 lows. It's just falling off a cliff. I did 5 years, and then I had to go back even further just to see how fast this thing has been dropping. Of course, look at the PE now, about 3.47. Yes, that's 3.47. It's yielding over 13%. One really good thing I'll say about this company, though, it has a really low payout ratio of under 50%, about 46.3%. And that's because this company actually has a lot of revenue. And I would give that as a positive for the company. But looking at the balance sheet, they only got $518 million in cash. That is not sufficient for what's going forward as far as I'm concerned. Their debt is $11.52 billion, and their current ratio is just not that great either at 0.23. So the reasons why I won't touch this, okay, I heard some rumblings today about them postponing cruises. I wouldn't be surprised if they cancel or shut down some of that. That's going to hurt the company so much, especially with their current ratio being where it's at. The fact that they don't have not much cash is concerning as well. And for me, the bigger thing is their reputation is going to be damaged for quite some time. People are not going to want to get on cruise ships for a while. And I think that, like I said, this whole silliness that's going on right now will pass, but I think the damage will be done here. And I would be very surprised if in the short term they do not cut that dividend if things progressively get worse. and the silliness continues. I mean, I look at my city where I live in Canada here, basically all the stores are running out of toilet paper. Just this insanity, even though nothing's even really happening here. I don't think there's even a case anywhere close by. If that continues, it's people's perception, right? It's people's thoughts of what's going on. And for that reason, I don't think I would touch this one with a 10-foot pole. So those are just a few reasons why I wouldn't touch that one. I wouldn't touch Boeing. I know that there's probably a lot of positives with both those companies, but I don't think this is over in terms of their downside. I don't think that the downside is over in the positive ones that I gave either. But if they continue to fall, I think that those are going to be some great buys. So again, like I said, to sum it up, guys, I think that this is going to get worse before it gets better. And I did mention that in my other video as well, that I linked at the beginning of the video here. I'm not buying as of yet, but I might be buying soon. I think that the panic is just overwhelming the market right now. And I'm not too sure if we're going to see even a 40% drop or more. It's quite possible. This is a good time for you guys to watch my other video. I'll link that one right here right now. This is one that actually didn't get very many views, where I show about how people talk about how the market, why get in the market when it goes up and down and up and down. It was kind of good timing. And I show over the years how the market, goes up and down and huge pullbacks, how long some of them lasted. So that's something to keep in mind, and to keep in mind in terms of your mindset and how you should be prepared. So my thoughts on this, I probably won't make another video unless things get progressively worse on this topic. I stick with the fact that I think this is extremely overblown. Again, my other video, I explained that. But I think that the market is taking this very seriously, and the short-term effects could be very, very dire. So that's just a warning. Be prepared, guys. Be safe. Be strong. If you are in the market and you want to stay in the market, which I personally think is a good idea, just relax. Things will be good in the long term if you're a long-term investor, and that's what value venture investing is long-term investing. So that's going to be it for today, guys, and I'll see you in the next one.